non-performing assets. Non-performing assets, also called non-performing loans, are loans on which repayments or interest payments are not being made on time. A loan is an asset for a bank as the interest payments and repayment of the principal create a stream of cash flows. It is from the interest payments that a bank makes its profits. Banks usually treat assets as non-performing if they are not serviced for some time. If payments are late for a short time, a loan is classified as past due. Once a payment becomes really late, usually 90 days, the loan is classified as non-performing. In this lesson, we will study the concepts related to and management of NPAs at banks. It follows from the previous slide that after studying this lesson, you should be able to define non-performing assets, understand the different norms regarding NPA, understand the impact of NPA. The RBI has issued guidelines to banks for classification of assets into 4 categories, namely standard assets, which are loans which do not have any problem or are of less risk. Substandard assets, which are assets which come under the category of NPA for a period of less than 12 months. Doubtful assets, which are NPA exceeding 12 months. And loss assets, which are NPA identified as unreliable by internal inspector of bank or auditors or by RBI, and the chances of recovery are nil. According to the provisioning norms given by RBI, the primary responsibility for making adequate provisions for any diminution in the value of loan assets, investment, or other assets is that of bank managements and the statutory auditors. Provisions should be made on the non-performing assets on the basis of classification of assets into prescribed categories. Taking into account the time lag between an account becoming doubtful of recovery, its recognition as such, the realization of the security and the erosion over time in the value of security charged to the banks should make provision against substandard assets, doubtful assets, and lost assets. Banks should make general provision for standard assets at the prescribed rates for the funded outstanding on global loan portfolio basis. The rates for direct advances to agricultural and SME sectors are at 0.25%, and for all other loans and advances are at 0.40%. For substandard assets, a general provision of 10% on total outstanding should be made without making any allowance for ECGC guarantee cover and securities available. In case of doubtful assets, 100% of the extent to which the advance is not covered by the realizable value of the security to which the bank has a valid recourse, and the realizable value is estimated on a realistic basis. Loss assets should be written off. If loss assets are permitted to remain in the books for any reason, 100% of the outstanding should be provided for. Now let us have a look on the factors contributing to the increase in NPA. Various steps have been taken by the government to recover and reduce NPAs, with a view to developing an institutional mechanism for sharing of information on borrowers or potential borrowers among banks and financial institutions. Credit Information Bureau India Limited (CIBIL) was formally launched on May 5, 2004 for collecting, processing and sharing credit information on the borrowers of credit institutions, and serve as an effective mechanism for curbing the growth of NPA. Banks have to make risk and control self-assessment. The approach is forward-looking, less rigorous, as the people drawn from fields who know the processes best are involved in the survey. The measurement framework is designed to focus on the principal drivers and controls of operational risk and is measured through a series of organization-specific risk-based weighted questions. The responses are then calibrated by adopting structured approach to enable the operational risk experts to identify and assess risks in order to plan appropriate actions. The NPA management includes compromise and one-time settlement. If the negotiation and compromise resolutions fail, then the option left with only is to proceed against the borrower legally to ensure quickest possible action. Banks are free to design and implement their own policies for restructuring or rehabilitation of the NPA accounts. Reschedulement of payment of interest and principal after considering the debt service coverage ratio, contribution of the promoter, and availability of security. The mechanism of corporate debt restructuring for multiple banking accounts under loan syndication or consortium accounts with aggregate principal outstanding exposure of Rs 10 crores and above from banks and institutions was introduced to ensure timely and transparent mechanism for restructuring the corporate debts on viable entities facing temporary financial difficulties. The banks can enforce their securities by initiating recovery proceedings under the Recovery if Debts Due to Banks and FI Act 1993 by filing an application for recovery of dues before the Debt Recovery Tribunal constituted under the Act. Lok Adalats are made for the recovery of small NPAs up to 20 lakhs. It is a speedy way to recover the NPAs. For claims below Rs 10 lakhs, the bank can initiate proceedings under the Code of Civil Procedure of 1908 as amended in a civil court. A NPA is eligible for sale to other banks only if it has remained a NPA for at least 2 years in the books of the selling bank. The NPA must be held by the purchasing bank at least for a period of 15 months before it is sold to other banks but not to bank which originally sold the NPA. Securitization and reconstruction of financial assets and enforcement of Securities Act 2002 provides for enforcement of security interests in movable and immovable without intervention of the court. Now let us check if we have understood the various concepts discussed in this lesson clearly. Standard assets are loans which do not have any problem and are of less risk. Right or wrong? Right. Doubtful assets are NPAs which are identified as unreliable by internal inspector of bank or by auditors or by RBI. Right or wrong? Wrong. Loss assets are NPA exceeding 12 months. Right or wrong? Wrong. Before we end, let us briefly revise what we have studied till so far. The Indian banking sector is facing a serious problem of NPA. The extent of NPA is comparatively higher in public sector banks. To improve the efficiency and profitability, the NPA has to be scheduled. Various steps have been taken by government to reduce the NPA. It is highly impossible to have 0% NPA, but at least Indian banks can try competing with foreign banks to maintain international standard.